Welcome to our fun video series. Now you can use these videos for yourself to get smart. Also, you could use these videos to help you pass securities licenses. So today's video is going to be short. We're going to teach you the difference between a stock, a mutual fund, and an ETF. Try to break it down, simplify it for you, so you know what we're talking about. So let's say I had ownership in Walt Disney. Well, typically they're going to give me a stock. So let's say I have one share of Walt Disney. So I'm part owner of Disney. Now, what happens though if Disney goes out of business? What happens to my money? It's gone. I'm sad. Lost all my money. So what the industry did many years ago is they came up with mutual funds. So a mutual fund is diversified. Now what we do is we hire a management company, maybe Fidelity, American Funds, T. Rowe Price, and what they do is they hire a portfolio manager. He takes their money, that's why he's smiling, and he has people that help him. He has analysts and other people within the organization. Now for this example, it's a large company mutual fund. So we're just gonna buy large companies. Now, in this example, we own a bunch of companies. We own Walt Disney, maybe some Microsoft. Would you like fries with that? McDonald's. Welcome to Walmart. Walmart. Big companies you might recognize, GE, et cetera, et cetera, et cetera. So the beauty of it is, what happens if Walt Disney goes out of business? I'm okay. I'm diversified. I didn't lose it all. So now there's expenses in a mutual fund. They're embedded. They're hard to see. Obviously there's different class shares, but basically there's an internal expense ratio in your mutual fund. Now the fees are going to average between, let's say, 0.80, to maybe 1.95. And they're in there, and you're paying it, so you're getting net of after expenses. Now, today, we have ETFs. And ETFs are very popular. And what's happening with an ETF is these guys over here, hasta la vista, baby, they're getting rid of. And basically, you're just holding strips of stock, or having the holdings without having these management people. So with the ETF, your expense ratios are going to be lower. So now maybe they're 0.15. So it's huge, the difference. So if you're smart, you should be buying ETFs. Now with an ETF, you have to pay a commission, to buy and sell them, similar to a stock, though there are some zero commission ETFs if you can find them. Now, mutual funds, you sell at the last price at the end of the day. So if the market's tanking, you're going to be hurting in a mutual fund, maybe. ETF, you can get out anytime you want because they trade like stocks. So again, if you're smart, ETFs are really the place to go. So I hope I simplified it for you, the difference between a stock, a mutual fund, or an ETF. And if you like this video, please subscribe and you'll learn more.